Welcome to Talk Tickers. Today we're diving into Southside Bancshares' second quarter earnings. And folks, this one is a classic Wall Street puzzle. The company reported great news, but the stock went down. Let's figure out why.
All right, let's get right into it. On paper, Southside put up a really strong quarter. But the market's reaction, well, that tells a totally different and much more complicated story.
You see the headlines, solid beats on both earnings and revenue. You'd expect a pop, right? Instead, the stock dropped nearly 2% on the day. So what gives? We're going to dig in and see what the market was really looking at.
First, let's cover the good news. Southside reported GAAP earnings per share of 72 cents. That came in 3 cents higher than what Wall Street was expecting. So that's a solid beat.
And it wasn't just on the earnings front. Revenue also came in strong, beating the forecasts by about 1.4%. So beat number one and beat number two. Things are looking good so far.
And this right here really highlights a core strength. Their net interest margin, or NIM, expanded. Now, if you're not familiar, just think of NIM as the bank's main profit margin. It's the difference between the interest they earn on loans and what they have to pay out on deposits. And seeing that number grow by 9 basis points, that's a very healthy sign that the fundamental business is getting more profitable.
Okay, so this is the mystery, right? We have clear beats on all the key metrics. So what in the world was hiding in the details that was negative enough to make investors hit the sell button? Let's go find it.
And the answer, the real heart of the bear case against the stock right now, it's buried in their loan book. Specifically, it's all about some very large and very unexpected loan payoffs that happened during the quarter. We're talking about $200 million, just gone, paid off early. Now, for a bank this size, that is a significant headwind to growth that just was not part of their original game plan. So where did this $200 million come from? Well, when you break it down, the lion's share, $150 million, was in commercial real estate. But there was also this $50 million chunk from a single oil and gas client that was a real surprise. And, management was caught off guard because, well, they said so themselves. The president, Keith Donnell, said on the earnings call that this oil and gas payoff was, quote, kind of out of the blue for us. You don't often hear that kind of candid surprise.
And the direct consequence of all these surprise payoffs? Management had no choice but to lower their loan growth forecast for the entire year, taking it down to just 3 to 4%. And that, right there, that was the headline that sent a major warning signal to investors.
But hold on, that payoff story isn't the whole story, not by a long shot. Let's flip the coin and look at the bull case, because there's a really powerful counter-narrative going on with the bank's profitability. Okay, so check this out. Management has this clear catalyst for profit margin growth that's totally separate from that choppy loan growth. They have over $430 million in higher-cost CDs maturing soon. They get to reprice all of those at today's lower rates, which directly cuts their funding costs and gives a huge tailwind to that net interest margin. And get this, even with those big payoffs, the pipeline for new business isn't just strong, it's actually growing. It's now sitting at over $2.1 billion, and that's up from $1.9 billion last quarter. This tells you that demand for their loans is still incredibly robust. This all fits into a much broader strategic pivot that management is pulling off. They aren't just reacting to things quarter by quarter. They are actively reshaping this bank for the future. So their long-term game plan is pretty clear. They're moving away from commercial real estate and pushing hard into what's called C&I lending. That's commercial and industrial loans. Basically, loans to businesses to run their operations. At the same time, there's a lot of M&A chaos in the Texas banking scene right now, and they're using that disruption to hire top talent and win new clients. And you know what? This isn't just talk. We can actually see the strategy working in the numbers. That C&I lending now makes up 30% of their future business pipeline. That's a pretty significant jump from just 25% 1 quarter ago. The plan is gaining traction. Okay, so we've seen the bear case, those unexpected, chunky loan payoffs. And we've seen the bull case, those expanding profit margins and a really smart strategic shift. So now, it's time for the verdict. Let's put it all together and make a call. Was this dip in the stock a real warning sign from the market? Or is this actually a buying opportunity in disguise? We are assigning a rating of outperform. We believe the market's negative reaction here was short-sighted. Here's our outlook. We expect that net interest margin to keep expanding, driven by that powerful CD repricing tailwind. We think loan growth is going to stabilize, and with a little help from share buybacks, earnings should tick up. The key takeaway for us is this. We think the market completely overreacted to the loan growth news and is totally missing how powerful this margin story is for near-term profits.
Our core thesis is that this stock is going to re-rate higher as that NIM expansion story really plays out over the next couple of quarters. The market is just getting bogged down in the short-term noise of those loan payoffs, while the real engine of profitability is just starting to rev up. You add in that successful pivot to C&I and management's confident buybacks, and the bull case becomes pretty compelling.
Ultimately, Southside presents a classic battle between short-term headwinds and long-term fundamentals. The question for any investor is, can you look past the noise of one quarter to see the profit engine warming up for the next? This is not financial advice.